So let's say I'm an expat, I live in the UAE, and my expenses are here. And let's say I put money in a foreign country, let's call it country X. And now, for some reason or another, I need this money. I need to purchase a property. I need to do something with it. And I go towards that country to get back my money. And the country has established a capital control where I can't take money out. So now I've taken another risk. So when it comes to cash, money markets, and bonds, what we have to be very mindful of is currency risk and then credit risk. And if you look at high quality, so where I don't expose myself to credit risk or significant credit risk, and I hold it in dollars, today yields are around 5%. Cross duration, they're around 5%. Whether I'm holding it for a day, a month, a year, 2 years, somewhere around 5%, plus minus.
Hello everyone, and welcome to Vault Presents Masters of Wealth. I'm Shehan, producer of the show, and today I have a very special guest with me for a very special episode. He will be answering and sharing insight to some of the most commonly asked questions in the world of investing and wealth management. So without further ado, please welcome Bilal Abou Diab, CFA.
Thank you. Thanks for producing and having the special episode.
Awesome. So I'm going to dive right into it. So Bilal, the first question that I have for you is, why is investment in general and wealth management in general very difficult to understand, although it's a very simple concept?
Yeah, that's a good question, right? I think the investment world has become more and more complex over decades. I think the complexity as well is there to protect individuals as well. So if you think about when we look at the simplistic version of owning an Apple share, what do we actually own, right? This is a company that I can have a specific ownership in because it's listed on a public exchange. And I have to have access to this public exchange. So maybe the way in which I access financial markets, which is I need access to a public exchange to buy shares of Apple from someone else. Sometimes that complexity makes me perceive that it is much more complex than I'm an owner of the company Apple in a very small way. And you see this very often where owners of equities don't necessarily feel like they have ownership in the company, but they own their shares. So they see it from a vehicle of trading a lot of times. So you see a lot of people who buy, let's say now NVIDIA has gone up dramatically, where they believe that they've bought NVIDIA with the intention of selling it, or they've bought a digital token on a screen, but the reality is you own something physical. So I think the complexity comes from how far we've come in a financial industry to be able to buy specific things. We look at mutual funds. Mutual funds essentially is me having a small ownership in a greater fund, and this fund owns multiple different financial instruments. Financial instruments being ownerships in companies. So now I own a small percentage of a collective fund that owns multiple different things. Now that might sound complicated, but in essence, what do I own? I own the underlying companies that the fund owns in a specific share. But naturally, we're defensive. Naturally, what we want to say is when we add this complexity, there's a fund. And the fund owns public shares. We want to understand the details, and the details can be quite complex. And you need a strong trust in the industry or in the practice to develop that comfort level with it. So I don't know if that answers the question, but essentially, there is complexity and structure that's there to defend the investor's interest. And that makes something very simple, like just owning companies, seem rather more complicated.
Right. And can you explain a little bit about what a fund is? Let's say someone who doesn't really have any idea what it means. So there's different types of funds, right? There's mutual funds, so many other different funds. So how do we break down what a fund really means and the different types of funds?
Yeah, so the common ones to look at, there's mutual funds and exchange traded funds. Those are the most common two. I think first what we have to start is understanding of what is a fund, and then we can go into the difference between the two. A fund is essentially I have an objective. I want to buy, and using an example, I want to buy the largest 500 companies in the US. And these largest 500 companies in the US are not just American companies. These are global companies. When I own a company like Apple, I'm not just owning a US company. Apple sells globally. So I take an allocation towards a really global company. So let's imagine I want to buy the largest 500 companies in the US. If I wanted to do so, I would have to go and buy each individual company, or I'd have to work for I would have to deal with a company who goes and buys every single company on my behalf. And that could be taxing. That could take a lot of effort. Whilst in a fund, you have many people who have the same objective. We want to buy the largest 500 companies in the US. So you have a fund, which is managed by a fund manager, and they have the objective to invest in the largest 500 companies. And the fund manager does that. So the fund manager goes and buys the largest 500 companies. And instead of me going and buying the largest 500 companies, I just go and take an allocation to the fund. So I own a small percentage or large percentage. I own a percentage of a fund structure, and I own its underlying. But now I have a fund manager that works towards that objective. So that's generally how a fund would work. So you have the fund is owned by the fund unit holders, so the person who owns the fund. The fund manager is there to fulfill the objective, so to execute on the objective, being, for example, the largest 500 companies in the US. And this example is the S&P 500, right? The S&P 500 is technically just a list of the largest 500 companies in the US. But when you want to invest in the S&P 500, how do you do so? Well, you need to do so, or the most common way to do so is to do so through a fund. So the fund could be a mutual fund or an exchange-traded fund, amongst other structures, but those are the most two common structures. If we look at a mutual fund, essentially, I need to find a way to go to the fund manager and say, I want to buy this fund. And I can go through a distributor, a wealth management company, or whatever, but I want to go and place money in this fund. And whenever I want to take money out of the fund, I do the same thing. I say, I want to take money out of the fund. And I put money in the fund, whatever its current value is, I take ownership of it. And whenever I want to remove, I remove from based on what is the value of the underlying. At the same time, with it, actually, and contrary to that, what an exchange-traded fund is, this fund itself is listed on a stock exchange. And now that the fund itself is listed on a stock exchange, I don't need to necessarily go through to the fund manager directly. I simply go and buy it from the stock exchange. And in the stock exchange, there's a lot of buyers and there's a lot of sellers. So it has a natural price. So I just go and I see who's selling, and there's offers and buyers and offers, and I simply go and buy the fund from a stock exchange. For multiple reasons, exchange-traded funds have lower costs and they're more easily accessible. You see, since the 90s, the majority of flows towards funds have now been going into exchange-traded funds rather than going to mutual funds because of their more effective cost structure. So that's in regards to mutual funds and ETFs and what is a mutual fund. If we want to take this forward towards passive and active, when we talk about S&P 500, that's a passive strategy towards investing. What does passive strategy mean? It means the fund manager hasn't really done any active decisions. The fund manager's job was to buy the largest 500 companies in the US, and the S&P 500 means put the larger amount of investment in the larger company. So the bigger the company is, the bigger it takes allocation. So the investor doesn't want to take the same allocation in towards Microsoft to a smaller company to the US, because Microsoft is so much larger, produces so much more goods and services. It should take a higher allocation, logically. So passive is, here's a fund manager who's not making active decisions. They're just simply replicating the S&P 500 by weights. And because they're doing so, they don't charge a heavy fee because there's not a lot of overhead going into doing so. Passive's rise came at the same time as exchange-traded funds rise. So people associate a lot ETFs with passive, but that's not necessarily the case. There's passive mutual funds as well. So there's mutual funds that have a passive approach, and there's exchange-traded funds that have a passive approach. But at the same time, there's active mutual funds and active exchange-traded funds. So let's talk about what is active. Active is, okay, we have this fund manager, and this fund manager is taking decisions on how to allocate. So now their objective is, instead of investing in the largest 500 companies in the US, it's invest in the larger US companies and the fund managers to choose which companies to invest in. So now the fund manager does, from these 500 companies, how many companies does this fund manager want to invest in? So they choose, this company, I don't like its future prospects.
Right. So there's more informed decision making that's
correct. And if you think about these fund managers, we talked about fund managers before, but if we look at what fund managers are, these are institutions that manage trillions of dollars. And because they manage trillions of dollars, they have very intense resources in terms of research teams. So you would have an analyst who their whole job is to look through balance sheets and reports of what is this company's potential future. So an active manager's approach is, should I select this company or this company? If I were to select both, should I over allocate to this one or should I under allocate to this one? So now you have a whole research team and a fund management team that are making informed decisions. Now, usually, because there's more informed decisions, there's more resourcing, the active fund manager is going to levy a higher fee for that management. But over time, what you see is traditionally these were active mutual funds. Now there's a lot of active exchange-traded funds that are very easily accessible. And because there has been a very big push towards exchange-traded funds from investors to save cost, what you've seen is the best active fund managers, a lot of them have listed their funds as exchange-traded funds and at a lower cost. So now you have a recent phenomenon over the past 5 years or a bit more, where you have active exchange-traded funds which are of cheaper fees than what was previously the case. And another point to mention is the fact that the reason why there was a very big move, so the debate between passive and active is a very long-lasting debate. And over the past decades, you could say passive has been winning. So what happens is there's a lot of research that has shown that active fund managers, as much as they're doing research and as much as they're making informed decisions, have found it very challenging to outperform passive. So they're putting all these resources, they're doing this research, they're deciding which company to over-allocate to, under-allocate to, company selection, all this process. And yet with all of this, you see that passive a lot of times is beating active. And therefore you've had a lot of, so it was hard previously for a lot of investors to justify, why should I be paying this fund manager an active fee if they're not outperforming passive? And that's one of the reasons why active fund managers started putting their funds on exchange-traded funds and lowering costs. It's, let's lower our costs to attract more investors. The approach I would follow is it's important to if you want to invest and you want to diversify the company ownership you have, or you want to diversify your investment, what you also want to diversify is the strategy. So you want to invest in passive because passive has a lot of benefits. It's low cost. It's shown that it's outperformed active in many different scenarios. But at the same time, you want to invest in active as well in the best fund managers because you want to diversify away from the strategy that passive holds, which is the largest company gets the biggest allocation. So having a diversified approach is very important, and reducing costs is very important. But that's a very long answer to the question about what is a fund. But
that's great.
But it's trying to explain it in its fullest detail.
Yeah. Bilal, you spoke about diversification, right? Now, I'm Sri Lankan, and in Sri Lanka, a money market fund or an equity fund would generally yield on average between 15 to 20%. And that's a very high return, right? And my question then there is, if my home country is generating such a high return, why should I bother with global diversification?
Yeah, so I think there's two things to separate. I think money market funds and bonds, we have to separate them from equity ownership, and I'll explain why. But let's start with money market funds and bonds. Money market funds and bonds, money market funds is essentially cash, right? So I have cash, whether it's cash in the bank or in a money market fund, and my cash is in a currency. And if I am generating an interest return, I'm generating it in that same currency. Same thing with a bond. Bond is I've lent money, and my receivable or whatever I'm going to get back is the same currency as the money I've lent, and my annual income is in that currency. So it's very important when we're talking about money market funds and bonds, we look at currency. So if I'm holding it in dollars, my risk is the fact that dollar loses value over time, and not versus other currencies, it's over its purchasing power. Because as a spender, I pay on rent or a mortgage or whatever I do, my expenses are in a specific currency. And the last thing I want is my purchasing power of my money to reduce over time. So that's what I want to think about. Now, when I'm putting my money in emerging market currency or a frontier market currency, so when I'm putting my money in a currency which is not dollars, euros, or GBPs or established currency, what we got to worry about is we got to worry about the reliability of this currency. There's been multiple situations in the past where currencies have lost dramatic value. Whether it's inflation or hyperinflation, currency is subject to very high losses. And therefore, I could be generating 15% from a bank on a currency, but what's the point of that if after 1 year or 2 years that currency has fallen down so dramatically that I no longer have purchasing power? So when it comes to cash and bonds, money market and bonds, that's what we need to be very mindful of. In addition to being mindful about the currency, it's where is my money held? So it's if my money is held in a bank, what's the quality of the bank? What's the quality of the bank to repay my funds? If I'm holding my money in a money market fund, where's the money market fund putting the money? Right? How are they generating a higher return? Are they taking what we call credit risk, which is risk of where the funds are allocated to which institutions? At the same time, in countries, there has been history of capital controls. Capital controls are where a country stops you from taking money out. So let's say I'm an expat. I live in the UAE and my expenses are here. And let's say I put money in a foreign country, let's call it country X. And now, for some reason or another, I need this money. I need to purchase a property. I need to do something with it. And I go towards that country to get back my money. And the country has established a capital control where I can't take money out. So now I've taken another risk. So when it comes to cash, money markets, and bonds, what we have to be very mindful of is currency risk and then credit risk. And if you look at high quality, so where I don't expose myself to credit risk or significant credit risk, and I hold it in dollars, today yields are around 5%. Cross duration, they're around 5%. Whether I'm holding it for a day, a month, a year, 2 years, somewhere around 5%, plus minus. When it comes to equities, it's very different. When it comes to equities, and I always like to go back to the basics of it, we own a company. And this company, what is it? It's producing some goods or services. It's an operating company. If they're a steel manufacturer, they're producing steel. If it's a gold mining, it's producing gold. If it's a bank company, it's producing future earnings in whatever currency it is. So essentially, it's what do I own? So when I own equities, my currency risk or my risk I'm taking is on my future profitability of the company, the future earnings this company is giving me. And why geographical diversification makes sense is if I own companies just in one country, my exposure is to companies that are only selling to that country. So if there is a recession risk or there is a flight of, we look at emerging markets, a lot of times there's very deep recessions where there's a brain drain, for example, or various different reasons. What happens is all companies start losing money at the same time. All companies' earnings go down. So the idea of global diversification is about how do I diversify my sources of future earnings from any geographical area. And the important part to realize as well is you look at more developed markets, and it's a sad reality, but it's a reality. When we look at the United States, when we look at Europe and other developed markets, these are markets because of the checks and balances and somewhat more of a political and corporate security, or there's a stronger environment there. You still see surprises, but you see much less surprises in the economic circumstance in these countries than you would in countries that are similar to home countries of our own, where it could be very dramatic because the size of the economy in comparison to the world is much smaller.
Right. So now you mentioned that ideally you would want to minimize minimize your risk by diversifying globally across equities and, let's say, bonds, right? But in the UAE, we see that there's a strong preference to real estate as opposed to global diversification in equities and bonds. Why do you think there is such a preference? And what exactly is the problem there, right? We've spoken about this many times. There is a big problem in the UAE when it comes to financial literacy, and as well as sub problems to that financial literacy. So real estate preference being one. What do you think is, in your opinion, the bigger problem? And then what are the smaller problems that are coming from that bigger problem?
Yeah, it's a good question. I think the first important thing to note is when we talk about equities and bonds, we usually say equity and fixed income. And why we say fixed income is because equities, our return is future profitability. But when it comes to fixed income, our future profitability is in somewhat fixed return, more reliable or more certain returns. And therefore it's bonds, but it's also sukuk, and it's also other different things that have more of a fixed return instrument to it. And the reason why equities and bonds are usually discussed as core portfolios, or the model for diversification, is you can own a very small portion of a very big company. So I can, with $1,000, I can own a part of Apple. I can't do that in many other asset classes. So that's the reason why it's very easy to diversify public equities. Also, when I'm investing in public equities, I'm investing in multiple different sectors. So it's not just the real estate sector. I'm investing in also manufacturing, industrials, consumer staples like essential consumer products, consumer luxury items, phone manufacturers, iPhones, etc. So that's in regards to when we talk about equity markets and diversification. When we look at the common investment theme, we talked about the UAE. What you see is there is, in the absence of having a lot of experience in investing in public markets, so it's either two things. Either I have the experience with having invested where I understand these aspects, I understand diversification, I understand how to allocate, I understand the logic behind it, I have that long-term understanding. So it's either the knowledge, either it's the experience from having done it and got my hands dirty and gotten it done over multiple times. So usually it's knowledge and experience. In the absence of knowledge and experience, it could feel tough. It could feel uncomfortable because you're going into uncharted waters. And that requires an education of understanding, okay, what am I investing into? How does it work? Why should I be expecting X percent of return, whether it's 5%, 10%, or whatever, maybe why should I be expecting that percent of return? Where does it come from? While you look at real estate, it's very tangible. It's very easy to understand. And either we have the experience through generations. So either I have family members who have been doing it, so I've been exposed to it at a long age. Either it's very easy to understand from a knowledge-based perspective, as in, okay, well, I own a property. This property, I rent it out. It's very simple. If I'm owner, I'm getting the rental income. And the property value, over long periods of time, why would it go down dramatically? I own a fixed asset, a very tangible asset. I can see it, I can check up on it, etc. So real estate is very easy to understand. It's very tangible. The risk in relation to that is the fact that it's very hard to diversify real estate. Owning one property is relatively expensive. And therefore, if I own that one property, I have risks associated to that one property. So for example, a tenant staying in and not paying me rent. So now I have to go and do legal challenges. A time where if a tenant leaves, I have to find another tenant and the property is vacated for a long period of time. Something happens particularly to the building or to the area that I bought in, something that's detrimental to that. Something that happens to the city. Something that happens to the country from a real estate perspective. So I've taken multiple different risks, which are concentration risks related to that one investment I own. And that's why usually in wealth management, what we look for diversification. And if you look at the core elements of a property, is the reason it has value is because it's shelter. And if I own that property, I own the shelter aspect of it, and I can rent out that utility, I can rent out that shelter. And that's why we see that in the wealth management industry, we see that similar to how we see other equities. When I own a company that sells food, that produces food. So if I own a company that that has wheat farms, takes out that wheat and sells that, what do I own? I own a company that has a utility, and that's food products, and it sells that out. So when we look at properties, we look at it as a subsector of larger equity ownership. But the tangibility of it just makes it so much easier to understand rather than understanding the aspect of diversified public equities. And therefore, it's, I think, a knowledge and an experience thing. And the way to overcome that is gather the experience by investing and get the knowledge. And probably that's what we're doing here, right? It's raising awareness for that reason.
So to continue on the topic of the problem in the UAE, right? So now we looked at real estate as one side of it. The other side has, if I'm not mistaken, been the lack of trust in the industry. Why do you think there is a lack of trust in the industry?
I think a lot of people have been burnt before. I think it's very important when you're investing in anything, whether it's real estate, financial markets, investments, or anything, it's very important to have transparency of what you're investing into. So what's the structure that you're investing into? It's very important to have transparency on fees. So what are the fees I'm paying and why am I paying them? So fee transparency, structure of what am I actually investing in, transparency. Is this actually diversified? Where is my investments going? Understanding the risks. There's a lot of times where people go into investments thinking they're subscribing to something more simple, but they're actually being concentrated in investments that are not suitable. So there are instances, or there's a lot of instances of people getting their fingers burnt by bad actors, lack of transparency. They set up expectations way too high where the investors promise 20%, but the reality is it's very evidently that this investment by logical circumstance will not generate that type of return. And I think that's the importance of regulation. The importance of regulation is to make sure that investors are protected. They're well informed in terms of whatever decision they're making and what kind of investment they're making. The fees are very transparent, and we're going towards that direction, right? We are in an environment where there is more and more investor protection, but as much as there is, people have got their fingers burnt in the past, and it is very important to get a second opinion. I would always suggest that when I go into, when I have anyone in the family or myself who have to go to a doctor for an opinion, if it's something important, if it's surgery, I take a second opinion or a third opinion even. When it comes to investing your savings, people work very hard to make these savings. People fight for their salaries. They fight, it's people spend less to save more. People fight for those bonuses. They build the savings, and making decisions in regards to it's important. So getting a second, third opinion, making sure you understand something makes a lot of sense. And the best advisors in the world will not mind you taking a second opinion. If your advisor advises you against getting a second opinion, why? What do they have to hide, right? I'm an advisor, and if
for your best interest.
Yeah, if a client wants to get a second opinion, I invite that, right? Because you want to make sure that the client understands everything and that this is in their best interest, and that's what good advice is all about.
So you mentioned bad actors, right? So in the UAE, what do you believe is the root cause for this mis-selling and this inconsistent advice?
So I think it's a global problem. I think there's that has existed everywhere. I think the only way it's beaten is with a high regulatory standard. So regulations definitely help in doing so. So the regulator has a very big part to play in. The UAE, you can see that the regulators have stepped up towards protecting that industry better and better. So regulation has a big place, has a big part to play. Otherwise, as well, if you look at it globally, it's the duration of which a country's wealth management industry or investment industry has existed for. You think about countries, mature markets like the US. Are there bad actors in the US? Yeah, definitely. There would probably be bad actors everywhere, but they're less common than they would be in other emerging markets. And the reason is because financial markets wealth advice has existed there for a much longer time. So the investors there have more experience. They have more knowledge. They have more experience. The regulator has over overseen that industry for a longer period of time. So I think in the UAE, it's a byproduct of the fact that the UAE is recently, in comparison, it's a new country. The financial industry here is new. The concept that I could own an American company while being resident in the UAE is not very old as a concept, right? When we talk about, whether it's 20 years or 30 years, it's relatively new. So getting ability to invest internationally from staying here in the UAE or from other markets is a process. And I think we're on the right direction. And the way forward is have a strong regulatory standard, get knowledge and experience. We need to promote financial awareness, us and our peers in the industry. We have to promote financial awareness. And at the same time, it's about having enough companies or enough good companies doing the right thing, competing in an environment where people do not mind asking for second and third opinions and doing what's in their best interest.
Right. Is, however, the way that advisors or some of these wealth management companies, the way that they're incentivized, does that have a part to play in mis-selling and inconsistent advice?
Of course, I think that's the case in every industry. The way you're incentivized, they always say you wanna assess the person you're talking to and what motivates them, see how they're incentivized. There's no doubt. Look at the medical industry. If my doctor is incentivized to sell medicine, then they're more likely to offer me meds. Same thing with surgery or anything. So looking at incentives is extremely important. And in the UAE, that's a common, it's not only UAE, it's other places in the world as well, but the UAE, this is a common practice where you have institutions who make entry fees. And a lot of organizations that take exit fees. So what happens a lot is if you're invested in something and let's imagine it's in your best interest and you have an advisor who is no longer having a vested interest in you being invested there, but instead, if you sell that investment and you buy another investment, regardless of whether it's in your best interest or not, the advisor gets an entry fee. Now, whether or not this affects the advisor's relationship, it definitely incentivizes them against your best interest. So whether that has changed the behavior of the advisor, it definitely incentivizes them to change. And therefore, you'll definitely have cases where you have advisors or you have institutions, whether it's out of design or whether it's out of pure naivety or out of incentive scheme, that happens a lot. So understanding the person that you're dealing with, how they're incentivized, is extremely important to judge the bias that's there with the person you're speaking to. And that's cross-industry, but especially in the financial industry. And you see that a lot in this region. Another thing that you see is insurance sales. Life insurance. So what you see with life insurance as well is, and the regulator has made very large steps to try to address this. So they've recognized this. And one of the things you see that when a life insurance policy is sold, the insurance company pays the bank or pays the distributor, so it pays the wealth management company, an upfront revenue as a sales revenue for distribution, as in you're a financial institution who has sold this insurance policy. For the insurance company, that's a business development cost, and therefore they reimburse the financial institution with that return. Now, if that return is very hefty, then that's an incentive for the financial institution to distribute the insurance products. That's a common problem across industry, but it's very important for the person who's receiving the advice to know the fact that when the financial institution is selling you that insurance product, they're getting paid a very good amount of money. So is it actually in my best interest or not? So how do you assess that? You assess that by asking good questions. Like, why am I being recommended this? How much money do you make off of this? Is this in my best interest? What are my different options? Then it's check with other advisors. Get a second opinion, get a third opinion. Why not, right? If it's an important decision to make, if it's a heavy monetary commitment, go for it. And I've been saying this in recent times as well. It's with the emergence of generative AI, you have a second opinion directly in your phone. you can take a third opinion or a second opinion directly from generative AI. You can say, okay, I am 40 years old and I've been recommended this. What do you think? Should I get a second opinion? And sometimes you'd be surprised where generative AI can give you a bit of guidance to see if that's in your best interest or not. But of course, I would much rather take a second opinion from a regulated or a financial advisor that has actual experience in the market.
So if we go back again to this industry in particular, in finance and wealth management, right? If, let's say, the bad actors are being incentivized by commission or a payout to sell you something, what do you believe, or how do you believe they should be incentivized? What is a better way for advisors, or what is a better incentive scheme for advisors? How should advisors be incentivized, I guess, is the question.
So I think there's two models that make a lot of sense. One model is where advisors get paid similar to how lawyers or consultants would, which is they would get paid on hourly financial planning. So they get paid on hourly basis based on their work. The issue with that, the incentive is, and you see this a lot in the legal industry, is now there's an incentive to overcomplicate things. There's an incentive for the advisor to suggest you need their services for much more hours. So I can introduce complexity to essentially try to push you towards giving me more hours to staff me more often.
Yeah.
So that has its disadvantages as well. The second practice you see is for an annual advisory fee as a percentage of assets under management. And that way the advisor has a vested interest, regardless of what the investor invests in, the advisor is getting paid the same. So whether the investor is invested in one product or another, the advisor is product agnostic. That's very important. You want to incentivize the advisor to give the effort, and that incentive is to grow that relationship. So you would see that aligns the interests between the client or the investor and the advisor, by the advisor motivated to deepen the relationship more and more, regardless if the client or the investor is put into cash, money market funds, equities, bonds, whatever it may be. It's how do you take more and more responsibility by deepening the relationship? That's what I would think is best. But those two models are the most common models now internationally being discussed. The issue with entry fees and exit fees is the fact that there is an incentive. There's an incentive to sell. And that's the issue there as well. And that's why that is one that probably gives the biggest incentive to make it less of an advisory industry and more as a sales industry.
Makes sense. I want to go back to diversification, right? There's a word being thrown out often, private market investments or alternatives. And they say that it's only accessible to professional investors. Now, my question to you is, what are they? Why are they only for professional investors? And why should anyone bother diversifying through those sort of instruments?
Yeah, so in the financial and in the investment industry, we usually classify things as traditional asset classes, which is equities, so ownership in companies and public companies, fixed income, which are bonds, sukuk, or other fixed income instruments, and cash. We usually call that traditional asset classes. And then we have alternative asset classes. Alternative asset classes, a lot is associated with private markets. What in the financial industry, what we consider alternatives, so alternatives is anything other than the first three, equities, fixed income, and cash. So when we talk about alternatives, it's usually private real estate is considered an alternative because it's hard to diversify. It's concentrated in a key area, which is shelter, et cetera, et cetera. Another alternative so that's private real estate, so you have to own it privately. Then you have private equity. So private equity is owning companies that are not listed on the stock exchange. So I either go and buy this company directly. So this is a company where I go to their owners and through an intermediary or direct otherwise, I own a part of this company directly and not through a public stock exchange, which means I have to do the due diligence. When something's listed on a public stock exchange, that means they have audited financials. That means there's a lot of due diligence made on the company before I'm buying it. The price is there for a reason. When I'm buying things on a private equity, I have to be making the decision of how much am I buying it for, what's the credentials, etc. So private equity is direct ownership in a company, and usually I can take access to private equity through funds. So there's private equity funds. So here's a fund manager, which is a private fund. And this private fund goes and buys 20 different companies or 10 different companies. They buy them on a private basis. They're negotiating the deals. They're seeing how they're going to buy it. How are they going to, once they buy this company, how are they going to shift this company? How are they going to change this company? And are they going to sell it? Are they going to keep it? How are they going to make money off it? So I can take an allocation as an investor to private equity funds. So there's private equity, and similar with private real estate, there's private real estate funds. So I take allocation in a fund that goes and buys private real estate or develops private real estate. So private equity, private real estate. There's also private credit, which is loans made to institutions on a private basis. So a company that's looking for money, and a private investor or a private fund that's lending it money, and they're setting the terms directly.
Right.
So there's private credit. And then there's other aspects, which is whether it's commodities or hedge funds, or there's other pockets as well of alternative investments. The thing about private markets, and the reason why it's reserved for professional investors, is in the industry, from a regulatory perspective, what the regulator does internationally is they look to separate professional clients from non-professional clients, or what they call retail clients. And the reason they do so is the regulator has a much stronger obligation. The reason they exist is to protect the non-professional client, right? They want to make sure that the non-professional client isn't subject to bad advice or getting access to funds that are more complex because they don't have the knowledge experience for that. So usually private funds, because they're more complex, because you're buying a fund that goes and invests in private equity, it's who's the fund manager and how are they allocating. Usually these are reserved for professional investors. So that's the first thing to note. The second thing to note as well is the reason why it usually has a high minimum is because if you think about these funds are of larger size. So these are, private funds that, whether it's, let's imagine it's $20 or $100 million or $200 million fund manager. And this fund manager doesn't want to deal with 1,000 investors. They want to make sure that they're only dealing with a few investors, and it's easier for them to get 5 ultra high net worth individuals to fund that private fund to go ahead and go then collect $100,000 tickets there and thereabout. So usually those private funds, and the best private funds, are usually reserved to high minimum tickets, because the private fund manager, out of a position of strength, can set a high minimum so that they don't deal with a very large number of investors and rather have only a smaller amount of investors, because they have to do reporting. They have to report back, how has our fund done? They have to speak to these investors, etc., who are part owners of that fund, essentially.
So let's say, going back to the professional investor thing, right? You're saying that a professional investor is someone that has what criteria does someone have to meet in order to be a professional investor?
It's usually what we call in the industry K&E, knowledge and experience. So it's, do they have the knowledge and the understanding to make their own financial decisions? Can they assess an investment, whether they can go into it or not? So that's knowledge. And experiences, have they done so in the past? So knowledge and experience usually is there. Some regulatory environments, such as ones in the UAE, require you to have a specific minimum net worth. And the reason why is because it means that you can afford having allocations into private markets or more complex products as well. So it's knowledge, experience, and sometimes a minimum requirement of net worth.
Right. So why should a professional investor consider diversifying using private market instruments?
Yeah, so what you see is, you see the fact that private markets and alternative investments, what they're good for is they're very good for diversifying risk away from times where equities and bonds don't necessarily do well. So I think there's two things. There's diversification, and then there is return maximization. So essentially, when I'm diversified equities, you shouldn't expect a return that's dramatically higher than 10%, right? When I'm investing, when I'm properly diversifying my public equity exposure, 10, 13% that's a high return. To get to the situation of getting returns of 15, 20% plus, usually to get into those areas, you would have to go into things like private equity to generate that higher return. And the reason private equity generates higher return is because it's private by nature. So because it's not accessible to all and it's very hard to negotiate these deals, etc., private equity market usually has a premium, which is what they call a liquidity premium. So it's a premium for the investor because it's something that's not easily sellable. So today, if I own shares in the largest 500 companies that are public in the US, I can sell my holdings. I can liquidate my holdings with a few clicks of a button or a click of a button. In private markets, if I own the actual ownership of a company, not through a stock exchange, if I want to sell it, I need to find a buyer. So usually that is not very liquid. And to reward me for the reward for holding something that's not easy to sell means the price is going to be lower. So it's going to be less desired because of its more difficulty to liquidate. And that's why I expect a higher return from it as well. So private markets, in a lot of cases, there's some private markets that make more returns. So professional investors invest in it to enhance their expected return. So that's one. But another thing as well is a lot of research has shown that it's a good diversifier to having public markets. So professional investors, we could show up a chart which would show that the average family office, for example, allocates around 40% towards alternative markets, private real estate, private equity being the largest contributors. And the reason they do so is because in times where equity markets are going down, a lot of times private markets don't necessarily follow that same suit. And because they're illiquid, they have longer time horizons. Same thing with private real estate. Not necessarily private real estate doesn't usually make more money than equity markets, but it diversifies your return exposure from it. So it's a diversifier in terms of return, and sometimes it can generate you higher return. So it's to increase the overall portfolio return. And we can put up that picture to show that in terms of how a professional investor most usually allocates.
Right. Yeah. So now we spoke a lot about passive and active, and we spoke about diversification. But when it comes to the majority, I would say, right? This is maybe generalization, but myself as well, at least used to think that investing, what it means is to buy something now and then sell it when the price goes up. And now I've learned that it's not actually the case. There's a difference between that and the real true meaning of investing. And when it comes to, let's say, wealth preservation, long-term objectives, retirement, can you explain or touch a little bit on what is the difference and why there's such a misconception?
Yeah, I think in the industry we use a term which is more complex, but I like more, which is called asset allocation. Asset allocation means, okay, I have my wealth. How am I allocating these assets? Like, what am I owning? And within the asset allocation decision, holding cash is a decision to be made. And holding cash means I hold US dollars or whatever currency it may be that is subject to losing value and purchasing power. Can I go and just buy, wheat and store it at home? No, I can't do that. So whether I hold cash or whether I hold companies, there's an allocation decision of what should I own with my wealth. So now that I've generated wealth, what does my wealth look like? A lot of times, like you said, investing, a lot of the media that we go through, like if you watch CNBC or Bloomberg or whichever station is very popular, and you see this in banks and wealth management, where you see it on the TV. A lot of times what you see is you see tickers, you see the stock going up and down, and then you see charts. So a lot of or if you go to websites, financial websites, you see those tickers. So a lot of the media, because media is daily engaging, has been there to make us think about short-term movements and investing as an element of trading. And therefore, a lot of people, they perceive the fact that when I'm investing, I'm actually buying something with intention to sell it. And because our savings is in a currency and we just accumulate currency, we think, it's natural for it to just remain in cash or real estate. But that's not the case. Asset allocation is, where should I determine to put my assets? Should I be holding a currency where it loses value every year by design? So my purchasing power every year is going down? Definitely not. Like, no professional investor will have an asset allocation of 100% cash. It would be crazy, because cash is designed to lose value. It's designed to lose value in purchasing power. So over 10, 20, 30 years, I'm continuously losing value. So when I'm doing asset allocation, how can I do so? And usually that's where diversification comes in. I want to own real assets. So what are real assets? I'm owning companies. I'm owning real companies. They're solid. They produce goods and services, and I take allocation to it. Because equities, so ownership in companies, because some years this company will make more return and some years will make less return, that comes with short-term volatility. And what short-term volatility is the fact that my value of what I own goes up and down. So usually what investors do is, the best way to do so is you allocate towards fixed income to soften that increase and decrease in price movements, because it's hard to take. And that's where we invest in alternatives to diversify out of equities and fixed income, and we go into whether it's private real estate or whether we go into different asset classes, private equity, etc. So the decision of asset allocation and putting in a framework of asset allocation is much easier to consider. It's, okay, I have the wealth. I have to decide how to allocate it. Allocating it just to a few properties or one property in cash is a very non-optimal asset allocation.
I think then it goes back to why. And so let's say I've amassed a lot of wealth now, and like you said, you should now allocate it somewhere, whether it's in equities, fixed income, or real estate, or whatever it is. But why? As in, why should someone be invested than just keep it lying there?
Yeah, that's a great question, right? I think a lot of people don't ask themselves that question. I'm subject to that sometimes. So the question really is, why do we amass wealth? Why do we amass wealth? And people will answer that differently. But there's a commonality between the answers. And the answers usually are, people amass wealth for financial security. So one, I want to make sure that if an emergency happens, I have access to funds that can finance whatever emergency I encounter. Another thing is, I want to have enough wealth should I choose to stop working or choose to stop working what I'm currently doing. I have the financial security to allow me to do so. If some people have kids and they go like, I want to make sure that I've had a tough life and I don't want my kids to go through that tough life. So I want to leave them with a very big nest egg to give them financial security, financial stability. So really, it depends on what it means for different people, the details. But in general, it's about having security and stability. And what security and stability really is for future liabilities. I don't need it today. I've rarely met someone who's told me, I'm going to spend all my money this year. I've heard people who say, okay, I'm going to use my money to buy this asset. I'm going to buy this property. I'm going to buy this. So I have cash and I'm going to buy something with it of value. But I've almost never met someone who says, I'm going to spend all my savings this year on just lifestyle. So if that's the case, then what does that mean? That means my savings or my wealth is there for future liabilities, for future spending. So if I want to reserve this for future spending, I want to match my assets. When we talk about asset allocation, I want to match how my assets look like, what my wealth looks like, to when do I actually need them. If I'm not planning on spending my money, and I'm not talking about investing, I'm not talking about allocate, if I'm not looking to actually spend the money on experience and lifestyle over the next 10 years, what that means is I should allocate my investments accordingly to the fact that I will not be spending it over the next 10 years. So holding cash becomes a very bad decision because it's losing value over 10 years. And then owning one property establishes a concentration risk. So that's the way to think about it. So when am I eventually going to spend the money? That's in the future. Now, the most common situation you see is financial independence or retirement. So financial independence or retirement is you either have someone who is working currently or they own a business or they're working and they're working towards generating more and more wealth so that they have a pool of wealth that will allow them to be financially independent or retire. So this pool of assets gives them a monthly income. Either they're already retired and they have an amount of wealth and that has to give them monthly income. Now let's look at it from the viewpoint of someone who's retired. If there is someone who's retired, it would be a very non-optimal strategy to spend all of your savings this year. People who save for retirement want to make sure that their funds last them their entire lifetime, and no one plans to die. As in, you will not see someone who says, okay, I am 65 and I want this funds to last me till I'm 85. And when I'm 85, I'll run out of money. And if I'm still alive, I'll figure it out. That's not an optimal strategy. People want their money to outlive them because they never want to rely on anyone else. So for a retiree, someone who is as low risk as a retiree wants to make sure that their asset base is generating them a persistent income for their lifetime. So even a retiree has a longer time horizon. Even they want to have an asset allocation that gives them an income that's sustainable, that they don't lose out on for more than 20, 30 years. So now think about it for the person who's planning for retirement. The person who's planning for retirement, their time horizon of investing is not only just from now till retirement. When they reach retirement, they should be invested to generate them an income. So what I'm trying to get back to is, when am I eventually going to spend the money? Even at retirement, I'm not going to spend them all in 1 year. I want to get as much income as possible over as many years as possible, and usually achieve that by investing in the right asset allocation to generate you that income that you should choose for that not to run out.
So it's safe to say that before you invest with whatever money you want to invest, you need to first think about what you really want to achieve, and only then decide how and where to put.
Yeah, the best investment advice, and this is globally agreed upon amongst proper professionals, is investing has to have an objective. It's not just to invest. You can invest to invest, but then it really doesn't suit what you really need. So the first thing to think about is, what are your objectives? By defining your objectives, you define, okay, how I need to make sure that I don't lose money. That's usually the most common objective, but it's not over the next year, it's over a long time horizon. So I want to make sure I reduce losses. I want to make sure, what's that time horizon? Do I need an income? Do I not need an income? Can I have a large percentage of my assets involved in company ownership, which will make me more return, but will go through more short-term ups and downs? So having the objectives in mind is very important. Now, the best advisors are financial planners, are people who help you think about what are your objectives. And that's extremely crucial. But then after the financial planner or the financial advisor helps you think about your financial objectives, so now think about, make sure that the advice meets those objectives. So, okay, the objectives are well-defined, but make sure that now that the objectives are well-defined, is this investment being recommended, or this asset allocation that's being recommended, is it in line with this objective? Is it transparent on how it is, and what's the cost structure that's transparent as well?
Great. I'll end it on that. And thank you so much, Bilal, for being on the show. And I think I learned a lot as well. So thank you so much for sharing your insights.
Well, thanks for having me.